In exercise 14, it gives us an opportunity to look at errors occurring in property, plant, and equipment transactions. And given that these are long-term accounts, it's really quite common to have errors in property, plant, and equipment. And so we want to look at, how to make those correcting entries. And it's going to make a difference whether the error took place in the current year or in a prior year, whether the difference is a current error or it's a prior period adjustment. So let's look at exercise 14. Here's the narrative of the problem. We have a beginning balance. Looks like they had a purchase, they added freight and installation costs, they had repairs, and then they sold a piece of equipment. So we're to look at and determine if we need any correcting entries. So we might start with, this purchase here and look to see, is this accurate? Should we have included freight in the cost? Should we include installation cost? So that gets back to the cost principle. What is cost? And if you recall it correctly, it's all costs to acquire the equipment and get it ready for its intended purpose. So all of these are costs of getting it ready, right? We got freight to get it to our place of business, installation costs to get it ready so we can start using it. So those are all correct. Those are capital expenditures. Now this one, repairs, that's not a capital expenditure, is it? So we want to, that really should have been expensed. That does not have long-term benefit usually, so we're going to assume that that's an expense. So the expense then, how would we make the correcting entry? Well, it shouldn't have gone into the equipment account, so we know that we want to credit equipment to take it out of there. So let's credit the equipment account $500, and what should it have gone into? Well, it should have gone into repair expense. So it might be maintenance and repair expense, probably when you go to Wiley Plus to actually do this. I'm just going to abbreviate that towards the end because I'm running out of space. So maintenance and repair expense, $500, decrease equipment, $500. Okay, then moving on, let's go ahead and post that $500 into that account, and we can see, we have an increase and a decrease, and that's going to cancel that account out. So after all of that, when I take the debits minus the credits, so debits minus these two credits, we should get a balance of $147,150. And that's going to be this beginning balance of $134,750. And then if I add these, this acquisition and these three costs, the $32, the $700, and the $2,700, I'm going to get those have a cost of $35,400. So this ending balance consists of the beginning less what we sold, plus the new purchase, $35,400. Okay, so we need to record depreciation expense here in Part B. Now they actually have a policy. Depreciation is to be charged for a full year on the ending balance in the asset account. So that tells me there's no depreciation if we dispose of it. Now that doesn't meet generally accepted accounting principles, does it? So if we dispose of a piece of equipment in the year that we sell it, or however we dispose of it, we will not record any depreciation expense. That does not meet generally accepted accounting principles. So how can this company have such a policy? Well, they can have a policy because the difference is probably immaterial. So what do we mean by immaterial, or material versus immaterial? Well, if it's immaterial, that means that the dollar amount is so small that it just doesn't make a difference. It's so small, the difference of whether we record depreciation on the disposal or not, that amount is so small that it's just not going to make a difference to an investor and creditor making an investing or lending decision. So it's immaterial. So if it's immaterial, it doesn't matter whether we record it or not. So it doesn't matter whether we fully meet generally accepted accounting principles if the error, or whatever it is that occurs, is small enough that it won't make a difference in investing and lending decisions, then we can have these kind of policies, and it's really common for a company to have such a policy. Okay, so we're going to need to remember that no depreciation in the year of sale. So we need to record depreciation expense for 2015. Okay, so we've got merchandise here that was purchased in 2013. So that $134,750 was purchased in 2013, and then we sold $23,000 of it, right? You can tell that in this journal entry. So the amount remaining at the end of the period is a cost of $111,750. $111,750 because they only compute depreciation on the ending balance. So the ending balance for the amount purchased in 2013 is $111,750. Okay, and if we use the straight line method, we would, what did they tell us? There's 10 years left. So we would just divide that by 10. And what do we get? $11,175. And then for the item purchased in 2015, that $35,400, there isn't any salvage value, so just divide that by its life of 10 years, $3,540. So my total dollar amount for depreciation expense, I'm just going to add those two together, and I'll get $14,715. $14,715. So that would be for number one. Okay, and I'm going to go erase all of this so I can come back and do some of the year's digits. So I'm going to pause and I'll be right back. Okay, I'm back. So we still have the same scenario. We have of our balance $147,150. $111,750 is from merchandise purchased in 2013. $35,400 was purchased in 2015. Okay, and we have the sum of the year's digits. So if it's a 10-year life, we can have our formula n times n plus 1, divide by 2. So 10 plus 10 plus 1 is 11, divided by 2. That would be 110 divided by 2. So we're going to have a denominator of 55. So over here, we're going to take 111,750 times something over 55. So now I have to figure out what that's going to be. Well, our numerator is in reverse order. So let's think about that. So in year 1, the numerator would have been 10. In year 2, the numerator would be 9. And here we are in year 3, and the numerator is going to be 8. Because the numerator is always in reverse order, 10, 9, 8, 7, 6, etc. Because this is an accelerated method, so we're going to have larger depreciation early on in the asset's life. So we're going to take that times 10 55ths, and that's going to turn out to be 16,255. Okay. Now over here in 2015, this is the first year of the asset's life, so the numerator in year 1 will be 10, again 55ths. So we'll arrive at a sum of 6,436. And if I add those two together, the 16,255 and the 6,436, I will get 22,691. Okay. We're going to go now look at problem 3 because it also deals with accounting errors. So in problem 3, we have this information. We've got 4 different scenarios. And then we're going to see it's 2015, and we're to make adjustments for or correcting entries for certain items. So the first one says on May 5th, machine A was sold for $13,000 cash, and the company made this particular journal entry. Okay, so we want to see, what do we need to do, because obviously, this company did not record this correctly. we really should, like in A, if we think about it, cash is going to come in for $13,000, so they did that right. But we also want to remove, right, if this is a sale, we want to remove book value. So that's going to include debiting accumulated depreciation and then crediting the machine account for cost. And then we'll compare this book value with cash, and either we'll have a gain or a loss. Okay, so we can see they didn't record that correctly, so we need to go back and figure out what we need to do. Well, first off, we need to record depreciation expense, don't we, up until the day of sale. So really, we need to go back and record, what would have been depreciation expense until that asset was sold. And, make our journal entry for debiting depreciation expense and crediting accumulated. So again, we can see that happened on May 5th. So, we need to record depreciation for that. All right, let's go up here. We can see in the a policy, in the year the asset is retired or traded in, they take a full year's depreciation. Okay, because normally here we would only do 4 months depreciation, right? Because they only held that asset 4 months. But because of this policy, and again, we would only have, we're going to see these two policies, they're only going to exist because of immateriality. So again, these two are immaterial, I-M-M-A-T-E-R-I-A-L, immaterial, or we wouldn't see these two things taking place as a policy, because they do violate generally accepted accounting principles, but again, they're allowed as long as it's immaterial. So really the first thing we want to do is record depreciation expense. So we have to figure out, let's see, it's sum of the year's digits, 10-year life, so that's going to be easy. We're going to know then the numerator this time is, the denominator is going to be 55. We just saw for that in exercise 14. For a 10-year life, n times n plus 1 divided by 2 will be 55. And then we got to figure out, how many years has gone by. Well, they purchased it in 2009, and they do not record any depreciation in the year of acquisition. So the years they would have recorded depreciation would be 10, 11, 12, 13, and 14. So 5 years have gone by. Here we are in 15, or the 6th year. So then if we think, well, what would those numerators have been? So the numerators, this is year 1, would have been 10. The numerator year 2 would have been 9. Year 3, 8, 7, 6, and we're ready for 5. So in our formula, our fraction is going to be 5/55, because year 1, 10, year 2, 9, year 3, 8, year 4, 7, year 5, 6, and here we are in year 6 of the asset's life in 2015, number 5. Okay, and then we want to take that times the amount to be depreciated. So we're going to take its cost, $46,000, subtract salvage, which is this $3,100. So we'll take that times 5/55. And you should get $3,900 with that. Okay, so let's go down. We saw for depreciation expense for the asset sold, $3,900. And here again, if we'd strictly been following generally accepted accounting principles, we would have taken that $3,900 times 4/12 to get the partial year depreciation. But again, because of immateriality, we don't have to do that. Okay, then step 2, after they record depreciation expense, now they can come in and record the sale. So let's go in and see what we should do. Cash debited $13,000. Accumulated depreciation. Well, let's see. They had a balance in accumulated depreciation of $31,200, and we're going to add $3,900 to that. So accumulated depreciation is going to be $35,100. And again, that is taking this $31,200 plus the current depreciation of $3,900 to get $35,100. The machine account, well, they've already credited it $13,000. They should have credited a full $46,000. So 46 minus 13, we need to credit that another $33,000. Okay. So they've already credited 13. We need to credit it another 33 to get the full 46,000. Okay, and then we're just going to figure out. By the way, I want to go back up here. I need to scratch this out, don't I? Because they've already recorded this. So they've already done that. We're not going to do that again. I was just kind of stating what they have done when I wrote that down. So it's correct that they debited cash, $13,000. It's correct that they credited the machine. They just put the wrong amount in there. They put $13,000 in there. It should have been a full 46. Okay, we see these two don't balance, so we need another $2,100 to balance, and that's going to be a gain on sale. Okay? All right, I'm going to stop this. And by the way, when this is all said and done, there would have been then the cash of $13,000, which they already recorded, right? They've recorded that. There was the cash debited 13. If I combine the two entries, if I combine this entry with what I did in black, there's a debited cash 13, accumulated depreciation. The machine has a total credit of 46,000, which is its cost. And so we have these two debits minus that credit. We should have a credit to the gain of $2,100 then, and we would be correct. But again, when you make your correcting entry, you'll leave out what is in blue when you're over on Wiley Plus. Okay, I'm going to stop. I'm going to erase everything I did, and I'll come back and we'll do B. Okay, on B, we actually have depreciation based on activity. So we have a machine, again, we have cost, less salvage. So we're going to have that as well. So 51,000 minus our salvage of 3. So we want to depreciate $48,000 of that asset. And again, we're talking about dollars here of cost. So $48,000 we want to depreciate. And they tell us they anticipate this machine can produce whatever it is, 15,000 hours of something. So we're going to divide by how much it can produce. So we're going to divide by the number of hours. It could be units, whatever it is. In this case, it's hours, but whatever it could be units of something. So that's going to end up being, let's see, 300. Hang on just a sec. What's it going to end up being? Actually, I think now that I look at this, it's 15,000 hours, so I need to go in and correct. So when I write it down, 15,000 hours, not 15. Okay, and so when we do that, that's going to be $3.20, $3.20 per hour, or for each hour, $3.20 per hour. And then they just tell us in this particular year, let's see, it had produced 2,100 hours. So we just take the 2,100 hours, and depreciation is going to be $3.20 per hour. And so when I multiply those together, you're going to get $6,720. So in your journal entry, you're going to debit depreciation expense, credit accumulated depreciation as always, and you're going to put your $6,720 in there. Okay, now we're finished with this. I'm going to pause and I'll come back and we'll do the next one. Okay, on C, machine C, management's changing. It's a change in estimate. So we have a change in estimate, and the first question is, do we have to make a journal entry for a change in estimate? Is it like an accounting error where we have to make a journal entry for is it a correction? And the answer is no. There is no correcting entry because it's not an error. We're just changing an estimate. When this asset was purchased, it was reasonable to anticipate 15 years. Now some time has gone by, and we're just going to change that to to a remaining life of 10 years. Okay, so we want to look at, what's in the accounting records, where we have cost and we have accumulated depreciation. So we have $80,000 in the asset account itself. We have $15,000 in accumulated depreciation for a net book value of $65,000. And then we just calculate our depreciation like we would. We take the remaining of cost that hasn't been depreciated. They're not changing salvage value, so subtract salvage. So the remaining amount to be depreciated is $60,000. And then we want to depreciate that over 10 years now, so that's our new estimate. And so your dollar amount for your journal entry is going to be $6,000. You'll debit depreciation expense and credit accumulated depreciation for that $6,000. Okay? All right, I'm going to stop again, and I will clean up my slide and come back and do item D. Okay, on the last one, we discovered that we have a machine purchased in 2014, and it was expensed in that year. So here we have a cost of $80,000 that was expensed last year, which isn't correct, is it? So we need to go back and make a correcting entry. So here we are, we're at the beginning of 2015, and that error took place last year. Well, for one thing, we know that $80,000 should be in the machine account, so we're going to put that there. Now last year, when they made this entry, they debited an expense, for $80,000 and probably credited cash or whatever for $80,000 or whatever, however they paid for it, note payable or cash, whatever it was. Okay, so, the question is, I need to credit something. What are my options? Well, should I credit this, expense account? No, because what happened to that expense account last year? Well, it got closed out, right? At the end of the accounting period, we zero out or close out the expense accounts to retained earnings. Expenses get close to retained earnings at the end of the accounting period. Remember, you've been doing that every month in Mix-Max. So we close those out to retained earnings. So instead of, crediting expense here, we're going to credit retained earnings. And credits increase retained earnings. So why are we increasing retained earnings? Because when we move this expense to retained earnings, that decreased retained earnings, right? We would have credited the expense and debited retained earnings. Debits reduce retained earnings. So at the end of 2014, we debited retained earnings for this expense. So we reduced it. So now we got to credit and increase it back in. Okay, and now that I've written this all down and used $80,000 up here as the whole cost, I see it was not the full $80,000 that was misrecorded. It was actually only $28,000. So I'm going to go in. I apologize for this, but it's just merely changing the 80 to 28. So it wasn't the full 80,000. It was really just 28,000 of that. So I'll do that. Who knows? Maybe my error will prevent you from making the same mistake when you're doing your homework in Wally Plus, that you won't go and pick up that full number. You'll read and understand this number out of this entire purchase, so not the whole amount. Okay, so $28,000, not 80. All right, so there's that component of it. And so also then we want to depreciate it for that. So when we go to make our journal entry at the end of the year for depreciation expense and accumulated depreciation. Now, do I need to make a correcting entry? Because also this company would not have recorded depreciation expense in 2014 for this asset. So do we need to make another correcting entry for that? The answer is no, because when the assets are purchased, they do not record any depreciation expense. So because of that policy, we don't have another correcting entry for that. Okay, so we got to figure out, how much is depreciation expense. So we're going to take cost of $28,000. There is no salvage. And then we're using double declining balance method at a 10-year life. So double declining balance, 10-year life, the straight line rate would be 1/10. And we double that and we will get 2/10 or 20%. So I can just take that times 2/10, and that will give me my dollar amount of $5,600 for depreciation expense. Okay. Okay, so in summary, I want to point out like in A, when we made a correcting entry, it was, the error took place in 2015, and so we just corrected it for 2015. But here, in D, the error took place in 2014, so we had a prior period adjustment. We had a prior period adjustment to retained earnings. Okay, so we had to go back and change last year's numbers via retained earnings. Okay, so that ends that, and we will. This actually concludes Chapter 11.